Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
To start by each one of you telling us a little bit about yourself, maybe a little bit history, professional history as well. What were you before, what you're doing now, and then a little bit about your companies and what, you know, just what that's all about. Ralph, why don't we start with you?
Okay, well, how much time do we have? I've got a long and very fortunate history in commercial banking. That's my start and my training for many decades. So I've seen many cycles, I've been involved in many businesses, but it's grounded in commercial banking. Here at TD, I have responsibility for both the consumer and the commercial side of the business in the metropolitan area. And I've seen some great work by some terrific bankers. And thank you for acknowledging the teams that work with Gail to kind of put the sessions together. And then when things really come together, it's moments of joining Coffee and Cap Rates when you get to work with James and Tamika in affecting the lives of individuals. Like Andrew, you did a great job in presenting to us. That's pretty extraordinary. And that's the value of working in banking. And your presentation was excellent in really capturing the momentum and what the change is that's going on. But TD, you've seen us. We're here about 25 years in the metropolitan area. We've started from scratch and we had to run pretty fast. A lot of our competitors have had about 150 year head start on us, but we've gained market share. We are the number one, the third largest in cap rate deposits here in the metropolitan area, so which is pretty significant. And we're going to close in on number two. At least that's my mandate for that. So
who's number two and who's number one?
So well, you know the names. They're very recognizable and very large. But we have them in our sights. Okay. One is going to be challenging, but two I think we have a shot at. So the message is, and you could see from just this being part of this building here and what we're able to do in this space. We believe in New York, we invest in New York, we see so much opportunity, and I like how you presented that, because when we see job growth, when we see kind of that movement between civic and corporate involvement, that really creates the economic engine that works, and we're here to support that, and my team does a terrific job, and we're going to continue to grow, and we're going to continue to invest here in New York.
Thank you, Ralph. That's awesome.
Good morning, everybody. Bryan Kelly with Gotham. So I've been in the housing business for over 20 years. I'm actually a child of, my father was one of 11. His dad was an Irish immigrant, so I can't say I've been generationally endowed into real estate. I've built over 5,000 apartments directly involved, blueprint by blueprint, brick by brick, closing by closing. Have joined Gotham over 10 years ago. We've built 5,000, nearly 4,000 apartments since then. We have 5,000 apartments in the queue. But when I say apartments, it's really, we're in the business of building homes. We're not in the transactional business. You think of real estate as being a transactional business. Most of what we do, and Russ Kivler, our attorneys here, will tell you it's like partnerships. So whether it's a not-for-profit that owns land that needs to be rezoned to create their new headquarters and affordable housing above, or it's state land where we're going to build Hudson Landing with Fisher Brothers on the west side, or it's Monitor Point on the Brooklyn waterfront where the MTA needs a new home off-site to unlock new housing. So it's a partnership-based business. Personally, have been really blessed for the last 10 years to work with a firm, Gotham, that's been in New York for well more than 100 years, whose ethos is really grounded in being fair and doing good. You obviously have to make money, otherwise I can't get a loan. But we're double bottom line oriented, and so that's the crux of what we do, and that's my background.
Thank you.
Good morning, everybody. Shimon, first I want to say thank you for having me here, but also it's encouraging to hear some of what you've just reported about some of the sales that have been going on, instead of what I think a lot of us in this industry are also dealing with, which is a lot of doom and gloom. But let me just talk a little bit about myself. I've been in this business now for more than 40 years. I come from a family where my dad was in the business. He was a developer. And I like to say that at a very young age, maybe at the age of 10 or 12, I understood what air rights was. And when my dad came home from work every day, I was always interested in what it is that he had to do, whether it be construction, development, whatever it may be, and I guess I was destined to get into this business. Went to work for him when I was in my 20s, and then in my early 30s left his firm to start my own firm, Nelson Management Group. We own about 4,000 units of mostly rent-stabilized housing, but I have a lot of experience in owning and managing and operating apartment buildings. I like to say that I'm a classic operator. We come in every day and we roll up our sleeves and we get involved in the real nitty-gritty of operating apartment buildings. And I'll talk a little bit more later about some of the challenges that we're dealing with. But we have about 22 buildings, 4,000 units. Some is market rate. A lot of it is rent stabilized. We have some Mitchell-Lama.
Thank you. You know what? Let's stay there. Let's stay with you.
Sure.
And I love the fact that you come from a family of developers and ended up with managing existing assets versus developing yourself. What's the challenge? You mentioned challenges. Let's talk about the challenges today, and then if you can tell us a little bit about one or two opportunities you also see in this space. It's harder to manage. We know that. But what do you see as a manager of 4,000 units of both affordable and rent stabilized?
Well, I think it's every day I seem to wake up and go into the office, and it's a challenge. I mean, look. Any business where you're any business that you own, any business that you're running, any business that you're doing every single day there's always challenges. My dad taught me a long time ago that no deal that you ever will do will ever be easy. Right. But with our portfolio, I think that we're having a challenging time covering our costs without rent increases. It's daunting. It really is quite daunting. And in the face of that, look, I will tell you that I've never been a gunslinger. I've never been someone that goes down to Atlantic City and rolls the dice and says, oh, we're just going to be fine. I've always been kind of conservative with the amount of debt that we take, and so never over leveraging. But I've never had such a challenge as it is right now to just worry about covering our costs, especially in light of these rent freezes that we're staring down. And then what comes from that? What comes from that is what's happening to the value of our properties. Really, I'm not worried as much about selling the buildings and am I going to make a profit or this. I am worried about refinancing the buildings, covering the existing debt that is on our properties today. That is extremely challenging. And then it seems like there are less and less banks that are willing to lend on this. They don't want to take that risk. So I guess all of that just kind of works its way into that equation. And I think one of the things we suffer from as rent stabilized owners is that you have newspaper articles that talk about rents that are increasing and just kind of rents that are the fair market rent increases that are going on for vacant apartments. I mean, that is at the end of people read the newspapers and people hear that on the news that this is what's happening to rents. And what they do is they don't understand the esoteric aspects of the different types of housing. So they're conflating that. And at the end of the day, when you have an election and someone is touting that they're gonna freeze rents, of course, everyone's going to glom onto that, right? I mean, you walk into a candy store, you ask a little kid, do you want some candy? Of course, yeah. So those are the challenges. I'm sorry to say, I think that the opportunities these days are few and far between.
Yeah, thank you. And I know Ralph wants to talk about financing probably and tell us that he's not lending on rent-stabilized multifamily. Is that right?
No comment. Yes, that is correct. But what you shared is really the crux of the issue, and inflation. And I will tell you, I'm encouraged in the moment, in the last 24 hours, in what I'm seeing and I'm hearing. So I thought the Fed meeting was extremely important. And the tone and the messaging that's coming out of it, it's incumbent upon the markets to really tackle this inflation issue that we have, so that owners, operators, they can manage through these rising costs, and hopefully will create some stability in the expense side of the equation, so they can be a little bit more predictable, a little bit more financeable, create that durable cash flow. That's what a lender is really looking for, so that we can at least be competitive in providing you with sources of capital from that perspective. So, the interest rate environment is, I think, going to be the story for the next several months, and how that plays out and how the market reacts to it. And we're seeing indications of it today. I haven't seen what the opening looks like today, or whether the 10-year is moving now or not. But I think this gentleman is checking right now, so maybe we'll get a live report on it. But I think that's going to be the story that's going to play out over the next several months, and how the markets, how the banks react to that.
Yeah, thank you. And I think you're right. Interest rates are a big part of what's happening in real estate in general. But when you have interest rates coupled with rents that don't grow and expenses that grow, it creates a triple issue. And so that's what we're facing. And Robert and Ralph, I think you're absolutely right. There's a lot less lenders in rent stabilized housing today, and that is an issue for us. I want to talk a little bit about developing affordable housing, because Bryan, you mentioned a few deals that you're doing. I'm curious, you don't mind talking about the most recent one, which is the Intrepid, that I think your company won. If you can talk a little bit about what does it take to win an RFP, but what does it take to develop a mixed income or affordable housing? It's a lot more complicated than just something with a 485X or 421A, or just rental or condo, right?
Yeah, I think I could start, though, before even talking about the example of where our capital is allocated and why. So we develop all affordable housing, which I define as public-private development of rent-stabilized housing, but the hard data on that is very lowly levered with high levels of reserves, and we build new and really high quality, so at a low expense load of management, versus buying existing rent-stabilized, which has high capex, fixed rents, and few tools. There are tools, but you can't subsidize your way out of a housing crisis. The markets have a place. Liquidity has a place. So you can't take millions of apartments and use government money to solve a housing crisis. It just doesn't work. So where's our efforts? Our efforts are buying revalued buildings that have market rate components to it, so that with inflation of rents, there's longevity to the asset and there's residual value creation. That's sort of bucket one. Bucket two is the public-private space of building tax credit housing at scale so that you can operate efficiently, like the urban village. Thirdly is large-scale mixed income development like the Intrepid, or like Monitor Point, which I prefer to speak about because it's sort of greater on in its evolution. And the answer is why on that? Because you don't have to merchant build it. It could be generational, it's large scale. These are in high growth, high income markets where the affordability could actually be cross-subsidized. And you don't need government capital to sit in the stack to make it work, but accept the return over cost, call it your untrended net operating income, over your cost structure is sufficient to raise debt and equity. So those are the three lanes we play in. How do you get to all of them? A lot of Tylenol. You have to know politics. And frankly, call it intelligence or just call it patience. Maybe I'm too cheap to go out and buy land, but if you do, you better be really efficient and really good at what you do. So we're in the business of defraying our land cost and entering into partnerships so that we can create viable deals, because the cost structure of development in New York is so high. Regulation. So monitor point, Tylenol. RFP in 2019, negotiated transaction documents in 2022, 170 community outreach meetings, ULURP, land disposition, build the MTA a new replacement facility, 1,324 homes, 950 will be cross-subsidized mixed income housing like I described, and then 362 units in partnership with the City of New York. The administration has stepped up hugely to make that happen with the MTA. But large-scale development takes a long time. So tools are key. So I would say those are the avenues we take. Those are the kind of developments. So yeah, the Intrepid is it's a public RFP. It was a competition. It's state land, and the state selling its land following a public process to create the entitlements will allow north of 1,100 homes, a cultural anchor with a secondary home for the Intrepid, plus bus parking. And it's a joint venture development with Fisher Brothers and Mural led by Robin Ziegler. Great partnership, and it's to create public good, but again, that will be years to get on the ground. So we need a lot of tools to net gain housing and to not lose. And so I'd say the one area where we're very weary of is revenues that don't grow and expenses that do. My son's going into 5th grade, he would tell me, Dad, that's a bad deal.
I'll hire him.
Don't worry, I'll call you in about 10 years.
That's great. And you know, there's so much that you said there, Bryan, and the two things that I took away is that market rates help your buildings subsidize the rest of it. So the mixed income is super important, and it doesn't necessarily depend on public money that is the taxpayers' money. And the second thing that you said that I thought was interesting is that you can subsidize yourself out of existing low-income, rent-stabilized assets. And I have a question for Robert on that, because we do know that there is a tool called an Article 11. It's a tax shelter for rent-stabilized. A year ago, there was also a tool called 610 Amendment where you could increase rent stabilized with voucher units and so on. How do you see, do you see these tools, and do you see them helpful at all, Robert, on rent stabilized housing?
I have to say, unfortunately, I don't. The Article 11 program, I don't think really is going to do much for you as an operator or an owner today. It's a shame because I have a number of properties that have Article 11 tax exemptions, but you still are faced with a set of circumstances where tenants who are vacating apartments that have lived in these apartments for 20, 30, and 40 years. And when they've lived in these apartments for that long and you get a vacancy back, you have to spend $40,000, $50,000, $60,000, $75,000, $100,000 to renovate that apartment. The economics don't work. What rent stabilization allows for are, you to spend $30,000 or $50,000, and there's a formula, but the return on that renovation is less than 6%. So let's look at the debt markets today. You're probably borrowing in excess of 6%. So what are you doing, right? You're getting these vacant apartments back, and you're just churning, but there's no return on investment. So it doesn't make sense, which is why you have 57,000 units that are vacant. You have owners that are just not willing to make that investment. And then, as you pointed out, Shimon, also there was a program called 610 where you could re-rent apartments based on the HUD fair market values. And if you had a 610 agreement, it was higher. You could rent those apartments for higher than the rent stabilized legal rent. So, but then we kind of ran into issues with the federal government's funding. The budgets, the budgets that the federal government was putting out was crimping the ability to do the 610. So then all of a sudden HPD started to pull back in, and so it's not something that I personally would underwrite in the acquisition of a building today.
Yeah, it's fascinating because before 2019, before HSDPA, there was a lot of alignment when it comes to rent-stabilized housing. You had a unit that's vacant, you could increase the rent through IAIs, individual apartment improvements. That's gone, and you're absolutely right. $50,000 gets you maybe $180 a month. It doesn't cover anything. So the legislators should think about incentivizing private money to go back into these rent-stabilized, and what you're saying is the subsidies are not that helpful. That's what I'm hearing.
That's correct.
Thank you. Okay, Ralph, where are we lending today? What property types? What is your ideal, lending environment? We spoke about good sponsors, good assets, good business plans. How do you guys view the world?
Durable cash flow. So the way you outlined your presentation today, I think really captures where the market is and where the banks are today, and certainly around quality assets. The quality asset classes, multifamily. I'm encouraged about retail corridors, especially in those high traffic areas. I think that is very strong. Mixed use, I think also opportunities there that we're seeing, and the banks are taking advantage of. So that durable cash flow, that relationship banking, I think understanding a client's investment theses and how they want to go to market and how they want to run their companies, I think is very critical for the banks in determining that. And then really looking at the quality of your portfolio. And I think that's important. And when you're dealing with strong, stable institutions, I liked your little fish kind of going across there. I think that's going to create a little bit of challenge. So for investors and sponsors looking at banks that are stable, well capitalized, have a disciplined approach to how they want to go to market with debt, I think that's where there's going to be tremendous opportunity in that flight to quality and the quality that's being created. And I'm very encouraged about from what I'm seeing and where we've evolved over the last 2 or 3 years. I think back over the topics we talked about during Coffee and Cap Rates, and to see how it's kind of evolved and strengthened, especially around office and the conversion. And I think that story is being written now and being tested, which is really important. We're going to get to a point where that's going to be a significant contributor to the value in the city.
Yeah, I completely agree. And by the way, you mentioned office, and we've seen a lot of lending in that environment, especially for bigger office, which was surprising. A lot of banks get together and have conviction in the Class A and Trophy. Back to affordable, and Bryan, I know you guys are doing a lot of public or partnerships with some faith-based organizations, probably more than many others. How do you do that? And how does it work, to the extent that you can talk about it?
Yeah, the innovative urban village is more to talk about now, given it partially exists. It's a 2,000 unit master plan that evolved and started literally in 2016 when my father-in-law called me, and he's probably like the last guy to go to heaven, and he said to me, and he called me and said, "Come out and meet Pastor A.R. Bernard," and I started looking up who Pastor Bernard was, and I was like, this is like, wow, where am I going? And so development, like I said, is not a transaction. I lived and learned of what the church wanted to accomplish in the greater community. And we spent many years doing community outreach. We went through a full ULURP. I think many of you guys know what a ULURP is. and we transformed a site that was zoned R5 for 400 apartments, which would be allowed by right, which is really a parking lot for one of New York's greatest religious institutions, into a community, which is 400 homes are being delivered literally now. We're in lease up. There's another 500 under construction. We're going to close another 600. And so, like, how did that happen? The church had the foresight back in the 90s to acquire the land next to Starrett City. It's an amazing institution with amazing people. You walk in it, you just feel warm the minute you walk in and better about yourself the minute you walk out. And they wanted to create housing that was diverse across a series of income bands. So the church said, rather than selling out, let's convey our land to build housing, and we'll do it by unlocking the land and building a parking garage. So it's 10 buildings, 2,000 units. We're going to build a performing arts center. We've done a workforce development program that's put hundreds into better jobs. We're opening a fresh grocer, pharmacy, a daycare, including, we're reviewing finalists now to include 24/7 childcare. But that was done by a cultural, religious institution saying, let's do better with our land, and there's a lot of that out there as a possibility. And so it unlocked a tremendous amount of potential. That market, though, doesn't have rents that are high enough that can give you that return over cost. So to the credit of the City of New York and state, we leverage tax-exempt bonds with low-income housing tax credits, and the sites are on former landfill, so using brownfields credits as well, and the city and state infusing a huge amount of gap money. But because of the scale, we've been able to do it really responsibly and cost efficiently with Monadnock Christian Cultural Center in Gotham. So that's an example of how nothing came from the ideas of Pastor Bernard into something.
Amazing. And I have a question, just if you don't mind. How long between the time you start a conversation to the time you started construction?
We're delivering our first homes this month. People will be moving in about 2 or 3 weeks. My first conversation was in 2016.
Wow, so 10 years until you see fruition in...
My father-in-law's in heaven now. We prayed
Yes.
a lot.
Yeah.
And more than just something. When you talk about the community and the wraparound services and all that comes about that, around that home, that's pretty extraordinary. And so when you say 10 years, feels like a long time, but the magnitude of what's being created will go beyond a decade.
Once the rezoning was passed in 2022, one of your competitors, but given the huge credit, Goldman Sachs advanced a line of credit. We spent a ton of money at risk with not a single promise to close. And then in 2024 and then 2025 subsequently, the city and state respectively did 2 closings where we put about $750 million of investment into the ground. So it's not done by Gotham, it's not done by Monadnock, it's not done by the church alone. It was done in partnership, and so it's not to my credit, it's to many, many people's credit.
Thank you. We're going to start closing out, but I have a few questions to all of you, and we'll start with Robert. And I think I know the answers to some of them, but let's see. If you looked at more attractive today, is it existing assets or development?
Development.
Development.
Right. Development, yes.
Brian,
Yeah.
I know what you're going to say.
Yeah.
I think buying existing assets that have a market rate component in the immediate moment is more attractive, given the reset in valuations. But development with the right fundamentals is a great long-term bet.
Yeah, you and Robert should switch chairs. Looks like you want to be the existing, he wants to be the developer.
It's a lot less guarantees and risk.
Yes, that's awesome. What do you think?
And I'm going to say both.
Yes.
So I get the easy answer on that. Yeah, to all the fundamentals that you talked about and how we approach it, and with the right sponsorship, with the ability to navigate through cycles is really critical for that. So whether it's development or whether it's existing, that's what we look for.
I think development is trending, but once core dollars rotate back into theme, versus everybody's, oh, I'm core plus and I'm value add. I'm like, what does that mean? Like, what's the difference? Can we look up the difference? It just means I want to make a 16 on buying a building. I'm like, well, why should you make a 16 buying a building? That seems pretty high, but it's correlated to interest rates, concern around regulatory matters, and inflation. So I think that's the justification of why folks want a premium to what seems rational.
One of the things I worry about is in this day and age, I guess in this city, I mean, is market rent growth. Market rent growth has been going through the roof for the last few years. How long can this continue? Where do rents have to go for all of the sudden for things to come to a grinding halt? Look, we do business in New York City. It's a very, very unique place. You know, from the day that I got into this business, there was always more demand than there was supply. And that's why you see this occur. But I mean, look, at the end of the day, I think that is why our mayor is in office right now. I think that he ran on a platform. He was going to freeze the rents. Again, as I stated before, you know, a lot of people conflate what that means from market rents and rent stabilized rents. But that's, like I said, that's a concern of mine.
Thank you. I think you're right. It is definitely a concern. The growth in rents is part because of the supply constraint, and again, part of what happened in 2019, where you took away the ability to convert some units into market units as well. My next question is going to be about interest rates. If we sit here next year, interest rates going to be lower, higher, or the same? Let's start with the banker.
So, Shimon, I always think of Mike Stoller when with that question, because he always had during his broadcast shows that crystal apple, and he would look into the crystal apple, and we'd kind of venture to say where we are. But back to my earlier comments about the current environment that the Fed has stated, market conditions will address the inflationary issues, because we have to get at that, because you could probably say there is a tipping point in the cost of whether it's rent, of whether it's goods, insurance, you name it. I believe we're at that tipping point, and the institution itself is not going to address it. It's allowing the markets to do that. So I will venture to say, and this is just one person's opinion, in the near term, the yield curve is steepening, which is encouraging, but it will address these inflationary challenges that we have. Because if we don't get back to the 2%, and they're anchored to 2%, which from a banker's perspective, I'm extremely appreciative of. It can't be 2 point something, can't be 2.8. That 2% really matters if we're going to get after what we need to get after to make it more affordable, to make it more financeable, to make it just more an opportunity, especially for young people that are starting out in their careers.
Thank you.
I would say, since I have to buy and build and make the numbers work, a couple of points on things that have helped. Land use, zoning, and policy, big A+ win over the last few years with City of Yes, a lot of rezonings and things alike. So big wins there. CRE reform, huge, big wins. So there's tools that have been available to push supply through the gate. I think the most criminal thing that exists is the insurance industry. We just got a quoted policy outside of our umbrella because we were delivering all affordable housing for $1,800 to $2,000 a unit, and my response was, is it the census tract? So there needs to be insurance reform, because insurance is killing rent stabilized housing and all affordable housing, and the neighborhood you're in should not dictate whether your insurance is $1,100 or $2,000. So payday loans to people to file lawsuits, scaffold law. If you have $400 a foot in trade costs to build a building, your then insurance load is $40 a foot. That's insane. Go 100 miles south, that load is $10 in Philadelphia. So we are doing a good job in certain areas of legislating betterment. That's the next target area to reduce, because you can't just keep raising rents. If you want to reduce expense load and cost load, that's where I would focus time.
Thank you. Robert, rates next year, higher, lower, or the same?
I'm going to pause for a second on rates. I just want to talk about something that Bryan was just mentioning about insurance.
Please.
If we don't do something about the scaffold law in this state, then you will never, I don't care what kind of insurance reform you're talking about. Right. Insurance reform won't do anything because you have trial lawyers that are out there. If you drive on the highways or you anywhere you see billboards, how many billboards do we all see about if you're in an accident, call us? The amount of advertising that they do is basically telling people, listen, if something happens to you, come to us and we will get you a lot of money. And I had a lawsuit in one of our apartment buildings. A tenant, I have cameras all over the buildings, everywhere, on every single floor, but we don't have them in the stairwell. So a tenant claimed that he slipped and fell in the stairwell and that he hurt himself badly. Didn't report it to us. Didn't report it to, I have 24-hour staff. I have a full-time doorman in that particular building. No one told us about it. We found out about it a year and a half later when we were sued. The gentleman, we took it to trial. We lost the case. We have to pay him $3 million. It's insane. He didn't. No one saw it happen. He didn't report it. But this is what you have. You have the trial lawyers that are out there telling people this is what they can do, and as a result, you have insurers that are quoting you rates that are astronomical. It's gone up maybe like 200-300% over the last 6 years.
We see that.
And unless we do something up in Albany about the way this works, you're not going to change insurance rates. But back to your original question, I think interest rates in the short term are gonna continue to move higher. I think the war, I think what's going on in in the Strait, ships are not able to bring us oil. Maybe it's not even oil, but it's contributing to inflation around the world, and ships are not able to bring us the goods that are packed onto those ships. And that is going to continue, I think, to cause more inflation.
Thank you. Any closing words from any of you? If we're sitting here next year, are we going to see a better New York and better investment market, the same investment market, or worse investment market, in your opinion? We're going to close with that.
I see that progression on discipline and that partnership and the creativity is, for me, over the span of my career, at its all-time high. And I'm really encouraged about, I am very optimistic.
I think New York it continues to bustle. I think the harder challenge for New York is the capitalization numbers are just tremendous. So it's not that New York's in vogue, but it's the cost structure of it is such that the equity investment amounts are so significant, so that is more the barrier. But I think the fundamentals of it itself are very strong for the kind of developments that I said we're pursuing.
Thank you. So another optimistic. You have to be, you're a developer.
Yeah, but like I said, fundamentals.
Yeah.
Matter.
Pied-à-terre tax, taxing the rich, taxing corporations. I think all of it hurts a little bit, but at the end of the day, this is New York City. And New York City continues to thrive no matter what it is that you throw at it. New York City continues to always thrive because there is only one New York.
Thank you. And with this optimistic note, I want to thank you, Robert, for being here, and Bryan and Ralph. Thank you.